Great. All right, David, take it away.
All right. So I was gonna that introduction was pretty great, but I was going to just jump through a couple of quick slides because I know that's kind of the way these things sort of tend to work. So I'm just gonna share my screen and pop through a couple of slides just so you guys can understand a little bit more about what we do and kind of where I sit in the industry. So as Joseph mentioned, I'm a loan originator, and that's a term that is somewhat ambiguous in the industry between direct lenders like myself and brokers. Brokers refer to themselves as loan originators as well, but they don't actually put any paper out. They don't fund any loans. They more so broker the transaction by bringing the parties together, the borrower and the lender together. But we're a direct lender. So you'd be our loan docs would be the documents that you would sign, and then our servicing team would be interacting with you over the life of the loan. So can everyone see this screen here, the slide deck?
Yes.
Mm-hmm.
Yeah, cool. So let's see. How do I do this show? I don't know which screen is showing, but anyway, so Hunt Real Estate Capital, some of you may know that name more than Lument. Lument's pretty new, but the company was started a long time ago by the Hunt family, and they are also heavily invested in affordable housing. And as you can see here, the two other companies that merged into Lument with Hunt were Lancaster Pollard and Red Mortgage Capital, Red Capital. Red was kind of a small multifamily player in the industry, but did quite a bit of affordable housing. Lancaster Pollard did a lot of healthcare. So most of the folks that are in our health.
David, I think you're frozen.
You guys hear me?
Am I frozen or was that David?
No, that was
I
David.
think David.
That was David. Okay.
Was frozen.
You guys got me now?
Yes.
Yeah.
And your slide is
Sorry
just
about that.
still first slide. So I don't know if you
Yep.
were.
Yeah, I didn't say much, honestly. But anyway, so we back in the end of 2020, the three companies merged, and so if you hear someone say that that they used to work for Red Capital, or now they work for Lumen, we're all the same now under one banner. So that's a little bit of the history, and as you can see, we're pretty widespread across the country. I'm based here in DC. Myself and a couple other originators, we have people all over the country. We're not geographically constrained. Most of my business tends to be in Missouri, in Kansas, Texas, Oklahoma, Florida, and Ohio. And then I've actually been doing recently quite a bit of business here in the DC area, but we are all over the country, and that is across all specialties. So multifamily, manufactured housing, seniors, affordable housing, all of the different product types. The only thing we're not overly bullish on right now, and nobody really is student housing. But we have all of those licenses as well. So we're actually a subsidiary of Oryx Corporation. So if you've ever heard of Oryx Real Estate Capital, that is kind of our parent company. And Oryx USA is owned by Oryx Corporation, which is an international company. And you can see there that we're all over the place, and we have a lot of capital markets and other non-real estate related financial businesses as well. So that's kind of new for me because I've always, been pretty focused on the real estate, and now we have our HR folks send around notices that include people that are in completely different businesses that I'm used to being a part of. But other than that, we have a pretty substantial platform. Our servicing portfolio is one of the largest in the industry, and we're set up. Everything we do is in-house. So when you have a deal with us and you have an issue, you can call me and I connect you with someone that's actually a Lument employee, not some other servicing team at Walker and Dunlop or Wells Fargo or KeyBank or another large bank that does servicing for other lenders. So we do everything for the life of the loan. Let's see, I think Joseph mentioned it in his intro, but so we're primarily an agency lender, which means Fannie Mae and Freddie Mac are kind of our largest products, and that includes, again, small balance and affordable housing and all of the different product types within those. We also do FHA and HUD loans, which are for construction or refinances or acquisition. It doesn't matter, but they're slightly different programs, which you guys have probably all heard about, have really low rates, but sometimes closing the loan can take a while. We also have proprietary financing, whether that be pref or mezz, construction debt or bridge debt, but we do have fairly specific requirements, and not everything fits the box for those. So for example, here's our bridge loan, minimum loan amount $5 million, which generally turns away a lot of newer investors that are looking to get a bridge loan on a $2 or $3 million property. That's just not a fit for us. Other than that, I guess that's really all I had. There's my contact information if you ever want to reach out. I assume Joseph will shoot this slide deck around in case you guys want to dig into it. I have other resources that I can send you guys with kind of product outlines of the loan terms and stuff for the different products. But in general, I don't want to get too much in the weeds on that stuff. So if you guys have questions on any of that or anything else that might be on your mind with respect to lending, I'd be happy to let you guys take it away.
All right. Well, this brochure, I will be sending it out to the attendees and attach it to the email. So you will get it later on. And if you have any questions, you could put it in the chat box. I have some general questions from the easy ones to more specific. So if I may cover your questions, but if I don't cover any questions, you could put it in the chat box, or you could just let me know. Then you could unmute yourself and speak up. So let's see. So, well, lending, if you're interested in purchasing or refinancing multifamily property, getting the right loan is the key. I think it's no exaggeration that at one point we all want to get on the agency side, right? So David, if you can explain, what is agency loan? Why is it called agency?
Yeah, so the agency loan is just kind of a short name for Fannie and Freddie, and even FHA loans kind of go into that bucket. But it's basically they're federally backed at this point. So without getting too granular, basically there's a guarantee that the federal government has on these loans. So they're non-recourse loans to start. They have carve outs for fraud and things like that, where if you commit mortgage fraud, the loan becomes recourse. But aside from that, they're non-recourse, and we as lenders and Fannie Mae and Freddie Mac as the guarantor of the loan, not on the loan, but of the loan, they're able to make more loans, and we're able to make more loans because it's not money that's sitting on anyone's balance sheet. So what happens is we write the loan, Fannie Mae guarantees, we write the loan, we end up securitizing the loan to an investor, meaning a bank, Bank of America, Citibank, Fannie and Freddie can buy their own securities as well. But then Fannie and Freddie actually guarantee the yield on that note. So whatever it is, a 3.5% rate on your loan may translate to a 2.9% yield for the investor that buys the mortgage-backed security. Mm-hmm. So they take on the risk, the bank takes on the risk, Citibank, Bank of America, whoever buys the security takes on the risk, and that money goes back into the pool that can be lent out. So that's why we're able to do between Fannie and Freddie, 140 billion a year.
Gotcha. Okay, so actually Fannie and Freddie are not giving you the loan, they're actually guaranteeing, and then they will make it as another security where they sell it to their own investors. Is that how it works?
Right. So all of these get securitized, and Fannie and Freddie do their securities a little bit differently. Every Fannie loan is an individual MBS. So whether it's a $1 million loan or a $20 million loan, it goes out as a single security that could be bought by, again, let's just say Bank of America buys it, and they take the yield on the note, which is the interest. Whereas Freddie Mac will take several loans and pool them into large securities and then sell tranches of those securities. So there's the A piece, and then there's the B piece, and it structured somewhat in a complex manner if you're not used to this stuff. But basically, it's still the same thing. It's a security that's getting sold to transfer the risk onto the balance sheet of a large bank that wants to be invested in notes, that wants to diversify or have that as an asset on their balance sheet.
Understand. So why is it so great? Why all the multifamily apartment investors want to have agency loan? I know one of the reasons you mentioned is being a non-recourse. Can you explain a little more about non-recourse loan?
Yeah, so non-recourse is, most of us are probably familiar with what happens when you take out a car loan or a credit card or even a home loan. You sign on the dotted line, and then it goes on your credit report, and it may knock your credit down. If you're late on your payments, you may have to call them up and say, please wipe it from my credit report, whatever you do. That doesn't happen with non-recourse loans because they don't make it onto your personal file, because what we're actually doing is we're lending to the business. So we're lending to, Main Street LLC or whatever the company is that's actually holding title to the property. So we're not lending to an individual. The only time, and what that means for you is asset protection in instances like 2008 or whatever, where maybe not that you wanted to, but you lost a property, you had to give the keys back through no fault of your own. The market took a nosedive and you just couldn't keep making payments, and you worked something out with the lender. That isn't going to drag you into a mess legally where your house and your car and your college fund for your kids is going to go up in smoke because you happen to be on the wrong side of a recession or something like that. So that's the real difference between recourse and non-recourse. Is recourse means the lender has recourse against all your other assets, and non-recourse we don't.
Mhm. So as a non-recourse loan, you're gonna reach only up to the property value. You can't come against the owners personally. Is that right?
Right. And so we can, exactly. So we can go, that's why the in 98% of cases, or maybe even more, we're going to be lending to a single asset entity, because we don't want any issues taking all of the assets of that entity and absorbing them, whether that be, cash accounts, checking accounts, escrow accounts, anything to do with the property, both assets and liabilities. We take it all if we take the property. So if it's a multi-asset entity, it becomes more complex because there's commingling, there's just other considerations when it comes to title and taking over. So to be honest, the default rate, or sorry, I guess the default rate and the number of loans that go bad with Fannie and Freddie is actually quite low. It's very low. You would almost think that these loans are risk-free. They're obviously not, but that's why the rates are so low, because going back to the securitization aspect of it is, Goldman Sachs, Citibank, these banks that buy these securities, they know they're guaranteed, and they know that the standards that we use to underwrite Fannie and Freddie loans are so kind of well defined, and we follow them, and we can't close loans without following them. So they know that they're pretty safe investments, and that does prove out in the data that there's very little default. So either way, they're non-recourse to the borrower, and they're guaranteed by Fannie Mae, Freddie Mac, and then again by the government. So there's a lot of layers of safety on these loans.
Okay, great. So is agency loan the only loan that's giving you the non-recourse loan?
No, but sometimes it's really hard to find other non-recourse lenders, and usually they're they're debt funds that are trying to carve out a space to be a non-recourse option. Pricing is going to be higher, their interest rates are going to be higher, but most banks you'll find are going to be recourse. And the other thing is too with agency, and this is another reason why people really like using agency financing, is the amortization is 30 years, whereas a lot of banks are going to be 20, 25 years, which means obviously that your payments every month are substantially higher than they would be on a 30-year AM deal.
Okay. And also interest rate is a lot lower compared to maybe community banks, right?
Right. Yeah. I mean, the spread is not always huge, depending on what market you're in. For example, like if you're in a very small market, as determined by Fannie or Freddie, the rate could be sort of on par with if it's a small deal in a very small market, the rate could be on par with a community bank or a local bank or regional bank. But if you're across the country in LA or San Francisco, or you're in New York or DC, you're gonna be almost always better with agency debt. But the alternative, or the other thing I would say there, is there are a lot. Every major city kind of has very aggressive banks. So, for example, Chase Bank is very aggressive on the West Coast. In New York, there are a couple very aggressive banks. They don't have as many options. It's kind of like they're a one-trick pony, it seems. They've got like a really aggressive 5-year loan or something with a year of interest only and no prepayment and no fees and a good rate. So, but if you're in those are kind of like the top markets and then the small markets. And then if you're anywhere in the middle, agency really is kind of it's just hard for any other bank or lender to compete, because agency financing will give you lots of discounts on the rate for meeting certain affordable housing goals, which is based on a percentage of area median income. And so if you're in really anywhere in suburban America, you're going to get really excellent rates with agency financing, and banks just aren't going to keep up on terms or pricing.
Okay, thank you. I have a Bill as a question. Bill, you want to unmute yourself and ask this question?
Yeah, thanks, Joseph. Thanks for everything, David. Just wondering what the current rates are for larger multifamily right now through Fannie or Freddie, and the terms.
Yeah, so the one thing I'll say first is, again, it does depend on what kind of deal you're doing. And one example that comes to mind right out of the gate is I'm doing a deal in Philadelphia, and it's brand new construction. And so the rents are, $3,000-4,000 a unit. And obviously not affordable to people at most levels of area median income. These are, the property has a spa and, just all these bells and whistles. And so that deal doesn't qualify or meet any of Fannie Mae's affordability kind of targets or goals. So the pricing on that deal is actually higher than it would be if it were a Class C deal right next door, or a Class C deal in a different, a less attractive market, or a less stable market. So, but on that deal, I think the rate was about 3.5%. And so if it were anywhere else, we probably could have been just over 3% on a deal like that. That's a $11 million deal. So take it, $11 million deal, solid Class C asset in a good solid market, could be, just over 3% right now.
That's
Excellent, thank you.
That's very good. David, would you stop sharing the screen so that we could have?
Am I still sharing a screen?
To me, yes.
Stop sharing.
There you go. Okay. I'm just gonna make a bigger view so that we could see people bigger. We have another question, but Ralph, I see the hand sign on it. Do you have a question? Is that why?
Yes, I do. Yes.
Okay.
Yeah. Thank you. Yeah.
I noticed that little yellow hand.
Sure. Thank you. Yeah. Thanks for being on, David.
Sure.
My situation is probably going to be pertinent for most people, as basically I was trying to get pre-qualified for a primary, and then my move after that is going to be buying a multifamily. And basically, due to my last two tax returns, because I have two careers, it just wasn't in the cards. So I had tried through Better.com and Rocket Mortgage, who are considered to be more basic mortgage lenders, we could probably say, from what I learned deeper. So kind of describe, and now I'm up to the stage where now I'm talking to a mortgage lender, basically an actual like broker, not lender, broker, which you would probably qualify more. So I think, kind of describe maybe the difference of, my understanding is the Rocket Mortgage, the Better.com, the guaranteed rates. There's probably some others, AmeriSave. I'm sure there's 10 you can name. That those seem to be for basically people with basic kind of 1W2 and like basic files. And my situation is not that basic, because I have, multiple careers, multiple properties. I guess kind of describe maybe, I guess the advantage and I guess I should probably never look at the guaranteed rate / rocket mortgages type again, because those seem to be for more generic or basic kind of loans versus maybe what an actual broker like yourself offers. If you kind of know
Sure.
what I'm asking for you to describe
Yeah.
that difference. Thank you.
Yep. So yeah, I appreciate that. It's a good question. I think one of the things I will say is I'm a commercial lender, so I'm not a true expert in the residential lending space. But one of the things I've realized is, at least in my opinion, I mean, I'm a numbers guy, but I think the commercial lending is a lot simpler than on the residential side, because I think you would think, oh, it's, debt to income ratio is what they tell you. But it's actually more complicated than that, because a lot of people like yourself, it's not just, W-2 and car payment, right? It's like there are more debts and there are more incomes that a lot of people have. And so it can get pretty complex pretty quickly. And what I would say is those, Quicken and Rocket Mortgage or some of those big name kind of mortgage lenders, they one of the things they're good at is closing quickly. If you need to close on a home loan in 3 or 4 weeks, I think they can do it because they're just so big. But you're right. I think they're a little bit less agile when it comes to situations like yours, which your situation, to me, again, just not being a residential lending expert, but in my experience, I think your situation is pretty well suited for a local kind of regional bank loan officer, where you can get them on the phone. They're going to look at everything. They're going to go over your tax returns. They're going to have conversations with their credit committee. They know how to kind of not massage your situation, but really take it and pack it all into the box that the lending box everything needs to fit into. So yeah, that's a challenge I think that you're seeing there, is that it's not really as simple as the advertisements that everyone sees makes the residential lending seem. The other thing I would just highlight is the difference between a lender and a broker. So residential or commercial, a lender is going to be, like, for me, like when I write a loan, it's on, Lument loan docs. And I do occasionally broker out deals. I help clients find other lenders when it's a deal that I can't do, but then that goes on another lender's loan doc. So I don't actually put any money out on that loan. I'm just kind of, again, facilitating the connection. So if you're in a situation like yours and every lender you seem to talk to doesn't have any idea how to manage your situation, and you just know that your situation is one that, you should be able to get a qualification letter for a new purchase, connecting with a broker might help, as long as they're a good broker. If you connect with a average or just kind of marginal broker, they won't add much value. But you connect with a good broker, and they'll probably have a Rolodex of half a dozen lenders that would be able to accommodate your situation. So that's kind of the difference, where a broker will have multiple different options to meet really unique situations. Whereas if you had one of those simpler cases, you'd just go right to a lender and say, I know what I need. You have what I need. Let's do it. And they would, give you a pre-approval or close your loan. And so that's kind of what I can do. Like if someone knows that their deal is set up for agency, they think it's set up for agency, it's a good fit, there's no need for a broker. I just do the loan myself, right? But if it's a loan that maybe it's a bridge loan, it's a $2 million deal, maybe it fits, maybe it doesn't, maybe occupancy is slipping, maybe collections aren't there, it's going to need a bank to finance it, that might be a deal that's well suited for a broker in the commercial space. Make sense?
Yeah, thank you. I was just going to add for everybody. Yeah, basically it was rocketmortgagebetter.com, and the reason that appealed to me is that it is a very easy dashboard that they have, or portal, to upload things when you have a ton of stuff. But as I discovered, basically the best way I can describe it is, after I got done with it, is they have they have no flexibility. So you have to be at this DTI or else, or this, or this, or this. And if you're not that, it's over. And versus my sense now, talking to a mortgage broker, just, once, that they can kind of mold and shape like a piece of clay, and they can make that work. And that's the difference. And I was hoping that maybe the Rocket Mortgage experience would be simpler, because they have that dashboard and portal, and it's easy to lay everything out. But unfortunately, it's kind of so auto assembly line that you have to fit in their box or else. And that's kind of the lesson that I took from it. And I think, other people on here, I'm sure, could, take a lesson from that too. Thank you.
Thank you. Thank you, Ralph. Okay, so today is Q&A with David about agency lending. I have a couple more questions. Let me see. JU, can you unmute yourself and ask that question?
Sure, I'll make it real quick. First of all, thank you, David and Joseph and Joe, putting this together. Really, bringing a lot of values for all of us. My question is, as a new investor, I think Fannie Mae is only require experience, and so Freddie Mac has the SBL, the small balance loan, and both available for experienced and new investor. And Freddie Mac SBL, I think it does not include rehab budget. So only for purchase, and it's not supporting the rehab budget. So how do we plan that as a new investor? Of course, we're gonna probably have key principle in structuring JV deal, and then to the extent, and how do we plan for refinancing after rehab is complete, for example, after a couple of years?
David, can I actually add a little more to that? I think
Sure.
answering that question, if you could touch upon, because my next question is on the similar line, like as let's say as a new investor, how can you be qualified for this loan? Would you request the new investor to be teamed up with experienced investor, or et cetera? Can you just give us some examples?
Yeah, no, it's a good question. And that's one of the first things whenever I talk with a new client who's getting acclimated to multifamily. That's one of the things that we spend some time on in our first call. It's the first thing, actually, before I say that, I did want to jump one more thing that I thought of about Ralph, what Ralph was talking about. He mentioned tax returns, and I often get sent tax returns by very well organized new investors that are coming to me for a loan, and I don't even open them, because in the commercial space, we don't need tax returns. So that's just an interesting point that Ralph had mentioned, that as soon as he said that, I knew he was talking about residential financing. But yeah, back to your question, Joseph and Jay. So both Fannie and Freddie have experience requirements. They are slightly different, and there are ways around both of them. Both things that you can do and then things that we can do as the lender, meaning waivers or exception approvals from Fannie and Freddie. But it's often, if you want to get an agency loan, like say one of your first deals that you're teeing up is a good fit for agency, and you really want to get agency loan, you want to save that 50 to 100 basis points on the rate by getting agency right out of the gate. Well, being part of a networking group, whether it's this or one of the other groups that are out there can be really valuable, because you probably have rubbed elbows with people that have experience and would be happy to sign on a deal with you and either be a JV partner or just be a key principal. And that's often what we see as people are kind of getting their first couple of deals under their belt. Generally, there are a couple things to keep in mind when it comes to experience. So I actually have a deal right now where we had to go get an exception from Freddie Mac for experience. But my client is actually a real estate professional. He's a licensed agent, a broker, and a licensed property manager in the state of Texas. He's been doing it for 10 plus years, and he owned 40 units or 40 something units, which consisted of quadplexes, duplexes, and single family homes all over the Dallas-Fort Worth metro. But that doesn't count as far as Fannie and Freddie are concerned, as far as multifamily experience. So obviously there's gray area. I went and I requested an exception from Freddie Mac, and they approved it basically with no conditions. So those deals we can get done, but it is important to keep in mind that just because you've owned a fourplex for 2 years doesn't mean that you have multifamily experience that will qualify you for an agency loan. So generally, there are 3 categories of size in the agency space that we look at as kind of comparable experience. So 5 units to 50 units, 51 units to 100 units, and 101 units and greater. So if you want to buy a property that's, say you own a property that is 20 units and you want to go buy a property that's 150 units, we're probably not going to be able to approve you right out of the gate without any sort of exception or waiver approval, because technically that doesn't quite qualify as comparable experience. But if you've owned a 60 unit and you want to go buy a 20 unit, that will generally qualify you, at least in Fannie Mae's eyes, that will qualify you as an experienced sponsor. The other thing to think about is how long you've owned the property. So if you own a 60 unit that you just bought 4 months ago and now you want to go buy a 20 unit, they're not going to give you credit for that. Generally, the threshold is 2 years. And I'm oversimplifying, of course, but if you've owned a 60 unit property for 2 years, and again, this is general partner, so you need to kind of have owned and controlled the asset for 2 years. You're most likely going to have all the boxes covered, or at least we're going to be able to push that through. If you want to go buy a 20 unit, 30 unit, 70 unit, something like that. And then, sorry, the other thing actually, aside from experience, the other thing that qualifies sponsors is we do have net worth and liquidity requirements. So like I said, we don't go after your tax return. We don't even look at it. It doesn't matter what you make as far as your income, because again, we're not lending to you as an individual. We're lending to your business. We're lending to your LLC, which the only income that your single asset LLC will have is the income coming from the property. So that's why the property underwriting is so important for us on a non-recourse loan. But we do expect our sponsors to have a certain level of understanding when it comes to finances, and just kind of the industry way of looking at it. And this is not just agency lenders, but lots of non-agency lenders as well use a 1x rule for net worth. So if you want $1 million loan from me, I need you, or you and your partners, you and your best friend, or whoever you're signing on the deal with, you need to have $1 million net worth, and that can be split $1 million with one person and $0 for the other person. But combined, you need to have $1 million net worth if you want $1 million loan. Liquidity is similar, but the rule of thumb I always use is if you calculate your annual debt service on the loan that you're requesting, we want you to have liquid assets that amount to that. So if your annual debt service is $10,000 a month, $120,000 a year, we want you and your partners to have liquid assets of $120,000. And the important thing to keep in mind is on a purchase transaction, that's post-closing. So after you've already come to the table with your down payment. So if your down payment's $200,000 and then your debt service annually is $120,000, you need to have at least $320,000 between you and your partners in liquid assets. And that's checking, savings, stocks, bonds, brokerage accounts, basically. Cash value life doesn't count. Retirement accounts don't count. Crypto, unfortunately, in this day and age, still doesn't count. So basically, you gotta have dollars in the bank or in a brokerage account, and you need to show that in the underwriting process.
So net worth in general doesn't include the equity in your primary residence, correct?
We do include that.
You do? Okay.
Yeah, so that's another slight difference between, you're probably thinking about the rule of what makes you an accredited investor. You have to subtract out the value of your primary. We include that in your net worth, and we do. Don't get me wrong. The life insurance policies, the crypto, all that stuff does count as assets in your net worth, but it doesn't count as liquid assets because they're not necessarily that liquid.
Thank you, Dave.
Thank you. VN, I know you had a question, but it goes kind of on the same line of questioning, but would you like to add anything else on that?
Yeah, I think what David just mentioned cover this question already. So, but typically, like, so if I'm looking at you right now, but if I have like 6 JVs total, do all of them normally go under the agency loan paperwork? Or do you know what I'm asking? Or I guess I just need one LLC and apply for the loan.
No, I'm sorry, I don't understand what you're asking.
Yeah, so like if I have like about 6 people, right, in a deal for JVs, so do all of us need to be under the loan?
So that's a very good question. What you're getting at is who has to sign on the loan, right? Like who has to be underwritten, provide their documentation, and be part of the transaction. And that's a really good question. So the simple rule of thumb, two thumbs, I guess, is one, if you're going to have, you or anyone else is going to have management control or authority over the property through the operating agreement, then you need to be underwritten. So you need to sign on the loan, you need to send us your documentation and be underwritten. The second rule of thumb is even if you will not have any management authority, think key principle, no management authority, but you're signing on the transaction, but not whether you're a key principal to boost the net worth and liquidity of the partnership, or you have greater than 25% ownership in the property. So sometimes you'll find an investor who doesn't have a lot of money, but they partner with someone who's really wealthy. They say, I'll manage the transaction, I'll work the deal, I'll deal with the tenants and the management company. You just, fund 80% of the transaction or 80% of the equity. And then after you get a 10% return, we'll split 50-50 or something like that, right? So that person, because of their percentage ownership, they would need to sign on the loan and be underwritten. They wouldn't necessarily, well, in that case, they would have to be a guarantor because the other guarantor doesn't have enough of a balance sheet to support the deal. But assuming the guarantors, there are other guarantors that could support the deal on their own, someone having more than 25% ownership in the property would require them to be underwritten. They wouldn't need to be a guarantor. They wouldn't need to sign on the loan docs, but they do need to be underwritten and have their credit pulled and have their balance sheet analyzed and provide documentation.
Okay. Thank you.
Thank you.
And that, just
mhm.
to clarify, that all gets back into the know your customer rules that are kind of just all over the financial industry. So we have to basically, anyone with more than 25% ownership, we have to be able to note that we know who they are and that they're not, a shady, party to be lending to.
Right. Yeah. Okay.
Thank you. There are a couple questions I really wanted to touch upon. Let's see. Okay. So prepayment penalty. Let's talk about it. What is it,
Sure.
and what types of prepayment penalty are there, and how can you kind of avoid being hit by a hefty prepayment penalty?
Yeah. This is front and center. I don't know if you guys have heard of prepayment jail, but there are a lot of people out there in prepayment jail right now because, a year and a half ago, 2 years ago, maybe now, we thought rates were moving up. And, people were taking 4.5% interest rates because they thought they were being smart, and they were going to, they were going to get their loans before rates started rising up to 5% and higher. And that was true for, 6 months. And then obviously things kind of went the other way. So now with rates so low, there are people that maybe want to sell a deal or refinance a deal because they've accumulated equity, but they can't because their prepayment is so high. And generally when the prepayment is so high, it's because they have a prepayment penalty structure that is either yield maintenance or defeasance. And both are fairly complex calculations based on present value or future value of the yield on the current note versus present value of whatever yield on the replacement yield or whatever. So they're done a little bit differently. But basically, just to give you an example, is I was working with a client recently who has a deal that he wanted to get out of. He wasn't sure we wanted to refinance or he wanted to sell, but I think he's at like right there at a 4.5% rate. I think it's a $1.7 million deal or $1.5 million deal, and it was originated in the end of 2018 or the end of 2019, something like that. And so it was only a few years into the loan term, 10-year loan, yield maintenance. His prepayment penalty was almost $500,000. So, you're talking about, $500,000 just to prepay a $1.5 million loan. So that's a lot. So the best way to avoid that is to get a declining prepayment penalty structure, which would be like 5.544332211 or something like that. And so that's the percentage of the unpaid balance in that particular loan year. So a 10-year loan would be 5.544332211. 5-year loan would be 5.4321 or 32111 or something like that. Now, the rate is higher for those prepayment structures compared to yield maintenance, but with syndications and deals where people are maybe getting into a 40-unit deal, but they know they're going to try to get into a 100-unit deal 2-3 years from now, you may not want to hold that property for 10 years. And so it could be well worth it to pay an extra 20 or 30 basis points in your interest rate to have the flexibility not to get hung up when you're going to try to exit the property. Whether it's because you're going full cycle on a syndication or you're trying to, sell and 1031 into a larger deal or whatever. Because the prepayment penalty it can be real money. But if it's only 1% because you structured your deal right, it's almost an afterthought. It's part of your, refi transaction or your sale or something like that. You just cough it up and move on. It's just part of doing business.
Thanks. I think another way was our second deal, we actually took it as a loan assumption. So the seller wanted us to assume the loan. Otherwise, he said he was going to have to put another $1 million of the purchase price because they have to pay $1 million prepayment penalty.
Right.
So we had to assume the loan. It was as if we're actually being in the seller's shoes and taking the loan as is. And now we are having that same loan with the same terms. So I guess that's another way to get away.
Yeah, I'm glad you brought that up because I'm seeing lots of that right now, where people are just doing loan assumptions. And there are a couple things to note about loan assumptions, just so everyone's aware. Agency loans are all assumable. So if I originate a loan for Joseph tomorrow, and then he wants to sell it a year from now to Jay, then Jay can take on that loan. We underwrite Jay, make sure he can support the loan with his partnership team. But other than that, the loan just transfers to Jay, and the monthly payments keep coming out. And it's pretty straightforward process. I mean, there's an underwriting process to it, but there's no prepayment penalty. Nobody has to cough up extra money, for that. The other thing to note is that Freddie Mac loans, Freddie Mac small balance loans, which are loans below $7.5 million, you can't do what's called a supplemental with a Freddie Mac small balance loan. Fannie Mae, you can also do a supplemental. So a supplemental is a second lien mortgage originated by the same lender that has the first lien. So in that example, if Joseph's selling a property to Jay, Jay's assuming the mortgage, but let's say he's paying a lot more than Joseph paid for it originally because Joseph, renovated it, upgraded it, whatever. So Jay may need more capital than just the existing loan balance. So he would go to the lender, the same lender that originated the first note, and say, I need a $2 million supplemental loan. So it's a second lien, and they're done so it's coterminous, meaning it matures on the same date as the first lien. So if there's 8 years remaining on the first lien, you're going to get an 8-year loan. If there's 8.5 years, you're going to get an 8.5-year loan. So it's done so that both loans mature at the same time. And that's really useful. But the important thing to remember in that scenario is the rate on the supplemental is going to be at prevailing market rates. So if you're assuming a loan with a 3.5% rate and current rates are 5%, your supplemental is going to be at 5%. Your assumption is going to be at 3.5 because it's the same note as Joseph had, but it's going to be so your total rate is going to be somewhat blended.
Okay, thank you. I have 2 more questions from Randy and Vian, but before I touch upon that, I have just last general question. For beginners, let's say for someone who's just starting and never had any relationship with the agency lender, what would you say to be a best way to build a relationship and without looking as if he's a tire kicker?
Yeah. So that's obviously challenging, right? Because, and I think that's sort of what turns a lot of newer agency investors away initially, is because they almost feel like they're taking too much from someone like myself, loan officer, because they're asking a lot of questions They're trying to get the answers and trying to learn. And it almost, I think a lot of them almost feel like it's out of place because they're almost using it as an education, which for me, I will say that's how I built my business, is being that resource for newer investors to help educate them. And I have several of my best clients. I worked with them for a year and a half before closing a loan. And the first loan I closed with them was, $1.5 million. And now they're doing $20 million loans a couple of years later. So for me, that I enjoy that part of it. I enjoy setting people off in their kind of real estate journey on the right foot and headed down the right path. And frankly, for those clients that I mentioned that have kind of really leveled up, it's made my life easier because they know so much about the agency financing process now that they might get deals under contract and have a signed PSA before they even tell me about the deal. I don't recommend that, but they know the process so well that they know that the deal is going to fit, and they know how, they have nothing to be worried about when they show me the deal with a PSA and say, okay, let's do this deal. So, I encourage, everyone to reach out. To me, I can't speak for other loan originators, but if you want to work with a loan originator and you want to build a relationship with that person, I understand that I'm going to put a lot of effort into our relationship up front and not get hardly anything back for a period of time until we become kind of partners, in a sense where you come to me with questions and I help you through deals and we underwrite things together. And we just know that we're on the same team. We're going to do transactions together. And ultimately, I'm in this business for the relationships as well. And I think you guys are, taking time out of your evening here on a Monday after a long day of work, presumably, to network and join me on this. So I would assume that you guys are also in this for the relationship as well and the long term. So definitely, if you're just kicking tires, I'd prefer you don't reach out to me, but that's very rare, right? Most people, they have questions they want to get answered. And if you want to get the right answers, you got to go to a professional. And so I'm always happy to be that kind of person to help you through whatever stage you're in.
Thank you. Thank you very much, David. So everyone you heard, reach out to him, build a relationship. Great guy, very knowledgeable, wealth of knowledge. You will learn a lot, and later we can do deals together, right? Okay. It's already 16 minutes past 9 o'clock. We'll kind of wrap up. I wish I could go further, but I know some people had to jump off. So last question I have is from Randy. Can you unmute and ask? I know we kind of touched upon the similar topic, Randy, but you might want to add a little.
Yeah, no, thank you. And David really addressed my question in his last response. So I'll reach out to David directly to see how we can partner.
All right.
Yeah, Randy, we were talking about a question in the breakout session. We didn't get a chance to wrap up. So just reach out and I can give you a little bit more detail on that.
Great.
Thank you.
David, one more time, how can people reach out to you? I'll send out that brochure, but do you have Facebook, LinkedIn, or?
Yeah, LinkedIn's great. I'm the quickest. My quickest responses are email, but LinkedIn, I'll always get to you within a couple of days. Instagram as well. I tend to post like pricing updates from the agencies and big news from the agencies on my Instagram. Just easy for people to see when they're scrolling through. But yeah, I would say email me, david.frasz@Lument. You can call me if you want, leave a message and I'll get back to you. And then obviously if you just want to connect and follow and kind of get acquainted, learn a little bit more about me, happy to have you reach out to me on social media as well.
All right. Thank you very much. And also, when I send out the brochure, I'm sure there's a contact information there as well, right?
Yeah, I think it's on the last page. You'll have my phone and my email. I didn't put my social media stuff, but Leos, if you can share that stuff with it if you want.
I will. All right. Thank you very much, everyone. We're gonna close up tonight, and I'll see you next month. Thank you, David. Thank you,
All
everyone.
right.
Sure.
Thanks, everybody.
Thanks, everyone.
Thank you.
These are production.
All right, hold on. There.